the company. A very good morning and thank you so much for your time. And firstly, let's talk about your guidance, because as per the guidance given by the management, the loan disbursements were expected to be growing in double digit, but for Q1 it's been around just 2%. So what will be your strategies to increase the loan disbursement further as per the target? What are the plans regarding that?
Well, yes, Q1 was particularly challenging for us in view of the rate cuts. Number one, the rate cuts were expected to boost demand, but unfortunately we did not witness that. I do not know whether the borrowers are waiting for further rate cuts, because further, as per reports, further rate cuts are on the anvil. So smart borrowers would be thinking, let the entire cycle be over and then we enter the home loan market. So that could be one of the reasons. And the other reasons was because the banks cut their rates very, very aggressively. We took some time to bring our rates down. So that was another reason for maybe a slightly subdued demand. Yes, the growth has only been 2%. We expect the growth to pick up in quarters 2, quarters 3 and quarter 4. But again, here, let me tell you, this year, because of these rate cuts, because of the reduction of rates by our competitors, especially the banks, we will have to take a call between growing the disbursement book, growing the loan book, and the margins. Margins would be under pressure. The problem with us is that, yes, our competitors are banks. Banks are slightly advantaged in terms of their cost of funds and cost of borrowing. So they are slightly more aggressive on lowering of rates. We are trying to match them as far as new business is concerned. So going forward, yes, it will be a catch-22 situation. What do we do? Do we look at the growth segment in both the disbursement and the loan book, or do we look at the margins? If pushed to the wall, I think we would have to probably sacrifice growth for margins, because we need to keep our margins intact, our names intact, our profits intact.
Right. So, Mr. Adhikari, while you're talking about margins, there has been a continuous decline in your net interest margins, your NIMs, since the last 2 quarters. Help us understand what is weighing heavy on your NIMs and what can we expect for the quarters to come?
Well, net interest margins, if you remember, during the Q4 media interactions, we had given the world a margin of 2.6 to 2.8. Right now, the NIMs are at 2.68, I believe. I think we will be in this range of 2.6 and 2.8 all through the year. Yes, margins, as I said earlier, are going to be a cause of concern this year because of the lowering of the repo rate by RBI. So going forward, let us see how it pans out. Of course, there are conflicting views whether there's going to be a cut in the August MPC or is it going to be deferred to the October MPC. But we are keeping a close watch on the margins. Yes, and margins, I think, would be largely impacted by basically our cost of borrowings. If I talk about the cumulative cost of borrowings, in this quarter, it stands at 7.50%, down almost 23 bips from the previous quarter. That means Q4, which was at 7.73. So there is an improvement in the cost of borrowings, but we also have to keep in mind that we have reduced our lending rates across the board for both new and old loans significantly. New loans by almost 50 basis points, old loans by 25 basis points. So right now it is kind of flattish. The repo rate cut, though it is being witnessed in the cost of borrowing, but it is not to the extent by which the repo has been cut by RBI. So we are keeping a close watch on the margins, the cost of borrowings, as well as trying to diversify our lendings into more margin accretive segments so that we are able to maintain this NIM between 2.6 and 2.8 when we end the year.
All right. Along with that, we have seen your project loans that has seen a decline of 70% on a YOY basis. Is it a structural shift in your portfolio mix, or what is your outlook for this segment going forward?
No, this is not a structural shift. It is not that we are exiting the segment or we are not interested in the segment. Yes, we want this segment to grow, but again, as I said, in view of our history of bad debts in this segment in the past, we are cautious. We are trading carefully. The board also has directed us to be slightly wary in this segment. We are going ahead. We have taken a target of doing good business in this portfolio segment. In the coming quarters, you will witness an increase. Yes, this quarter there has been a very marginal, I would say almost a negligible disbursement in the project loan segment, about 50-60 crores in volume wise. But going forward, yes, you will see some traction in this segment.
Okay, and Mr. Adhikari, if you take a look at the cost of funds, they have improved for you by 26 bips on a year-on-year basis this quarter. What initiatives have contributed to this improvement, and do you see further scope of cost optimization, at least in the near term?
Well, yes, the cost of our borrowing, almost about 57 of our borrowings are fixed in the form of NCDs. There we will not see too much of a traction in the lowering of the cost of borrowing because these are fixed rate borrowings. But 43% of our borrowing book is linked to repo, is linked to term loans which we take from banks. So there we have a scope for further compression, further reduction in the cost of borrowing. And that is precisely what we have done in Q1 and what we will continue to do in Q2, 3 and 4 is renegotiate our old borrowings which are at a slightly higher rate of interest and try to rewrite them at lower rates or repay the high cost loans and borrow at a lower cost. So that is precisely what we are engaged in. And that is why you see this reduction in the cumulative cost of borrowing and the incremental cost of borrowing. The incremental cost of borrowing has come down by almost 70 basis points from 6.97 to 7.66 to 6.97. So there is traction there, and we are aggressively working towards lowering our borrowing costs. Hopefully, in the coming quarters, with maybe one or two more cuts in the annual, and with banks passing on this cost to us in the form of lower rates, so we will see a further reduction in our cost of borrowings.
All right, Mr. Adhikari, with this we'll let you go on that. Thank you so much for taking the time out and speaking with us and helping us with the guidance going ahead, which is indeed giving some bit of a confidence back to the shareholders as well. So that was the management of LIC Housing Finance. The stock is holding higher by 2.5% as we speak right now. But time now to slip into a very short break yet again. Don't go anywhere. We'll be right back with more on the other side.